reviewing the Merkle tree and its role in blockchain. And so we know that it is used in Bitcoin and Ethereum as well. And then it has found another application in IPFS where large files are broken into smaller objects, and those objects are linked using a Merkle tree-like structure. So they are pointers and pointing to different of these objects so that they can be collected back into a file. Then we kind of the finance, the decentralized finance, and perhaps as I mentioned yesterday that cryptocurrency, if somebody intends to like Bitcoin, Ethereum, and other, it's better that we understand the DeFi so that we reduce our risk of losing our assets and increasing our profitability. So it is important that we know DeFi. So we started learning about finance, and I said finance is quite a complicated subject because it directly deals with money and funds and the investments, and there's so many different ways of investing money, and the people are basically master in this art. So they make a lot of money for their customers and perhaps for themselves as well. So we'll keep learning about finance, and then we go and see that how the entire finance is being replicated in decentralized finance. So whatever you learn about finance, the same, almost the same thing is replicated in decentralized finance. And if we find time, I'll go and do another design problem in designing applications or mapping applications on blockchain. So this is, again, yesterday we discussed it that one way of people who are investing is simply they buy some cryptocurrency, then they wait, and they've got to be very vigilant because all the time they are on the lookout, and the cryptocurrency swings by 30%, like in few days, perhaps in a day, it just goes down. So if you are not vigilant, you may lose a lot of your assets because of that swing. It is instead of just getting into this, blockchain-based DeFi is a better route. It has less risk, even if there is a dip, because it will automatically take care of that dip and will ensure that it only plays in the margins which you assign or which DeFi platform assigns to the investment. So this is a financial services without no central authority. So we need to, because of this, we need to understand what central authorities are in finance and how these authorities can be removed and will basically are replaced by code, by a software, by a smart contract. जी कोई question? Okay. So हमने देखना है कि how they are removed, and because still end of the day they are human. And but if you have a smart contract, that is an intelligent contract, that is dealing with instead of a people or a fund manager doing it. Perhaps you may have, like, if it's a code without any bug, you may have more reliance on the code, then you may have one people because they can fault, but not a piece of code. If tested thoroughly, covering all the use cases, can definitely perform better and uniformly across the users. So yesterday we started learning about finance, and especially central finance. All the terminologies, all the players, what is central, and how this whole thing works, the finance thing works, and then we'll start learning about the decentralized finance and the concepts and the products they are in the decentralized finance. And yesterday we discussed that finance can be defined that it is just the capital from the people who have it to the people who demand it or who need it. So it's just movement of money, the capital from one group of people to another group of people is called finance. And in this movement, both of them get something. The people who have finance have the capital, they get good returns on it. And the people who don't have it but need it, they can grow their businesses using the money from other people. So finance is this, that the people, and who are the people? They are just household people like you and me, and we invest our money. We put our money in the banks, and those who are smarter, they put their money in mutual funds. And so and then there are people who are more cautious about their returns. They may invest in, by themselves, they go and invest, or they invest in bonds and other securities, and so that they can get good returns on them. And the other side, the people who are just seeking funding, they are the CFOs and CEOs of different companies. So why people are taking risk on their money? Because they know it gets devalued, and no matter even if it is in dollars or pounds or in any other currency, it loses its value for sure. So there is this perspective. So just not investing means that you are just devaluing your savings. And if it is in rupees, we know that rupee is being hit hard, and you have no control. You can just, in despair, you can just look the rupee going down and down, and just hitting almost a rock bottom. So it is, rupees going down means it is reducing your saving, your capability to spend, your capability to buy commodities, because end of the day, rupee is nothing but a medium of transformation. So it is just a medium of exchange, actually. So the medium of exchange is losing its value, means that today whatever you can buy,
सर
you cannot buy. जी
स्टूडेंट्स वेट
जी
कर रहे हैं ज्वाइन करने के लिए.
अच्छा, सॉरी. क्या करना है? वेटिंग इन द लॉबी. ओके, ठीक है. Okay. So, so this is what is happening to almost every currency in the world, that it is going down, no matter how strong it is, because they keep printing more and more of it. And once they're printing, there's an inflation, and it starts losing its value. I told you about this MIT professor who says that it is moving and allocating money and risk. So once you move your money, you are also taking risk. So you are basically assigning risk to your money while you are investing into a venture. And so this is what the finance is all about, that you are moving money, and you are allocating risks to the movement, and this is happening throughout the economy. And then usually there is these central entities who help you to move it, as in hourglass, and this is where they sit, and they charge you fee for this movement. So what the DeFi does is that it removes the central authority. Okay, it replaces it with a smart contract, with a piece of code that governs that your investment and where best to invest. So basically, these are the lenders who are lending their money. These are the borrowers who are borrowing the money. So between lenders and borrowers are this neck, and in DeFi, there is no such thing as this deep neck. So we'll see that how the DeFi does this. Okay. So why there are risks? Because you are just investing in some other's enterprise. Usually they lie, those who need it, or if even they don't, they even themselves are not aware of the risk, and then you have no control over the enterprise. You can just see that it may just perform better. To mitigate the risk today, what people do is that they trust an entity, a central entity, and that charges for their services. So why finance is so complicated? Because there are so many entities and you got to decide where you intend to invest. So they are institutional investors, where they are like pension funds and mutual funds and hedge funds and endowment funds and the bankers and the traders and the brokers, and then sits here are the analysts and who are trained to read that how a company is performing. And especially these are the two types of companies and the businesses. One is a public listed companies. The public listed companies have a lot of responsibilities because the people, general people, public have invested in them. So they got to be very transparent. So usually in their board of directors, they have independent directors. Every quarterly, they have to submit their financial statement to the Security and Exchange Commissions, and those are the just public statements. Anybody who intends to invest, if they understand how to read a financial statement, they can read the financial statement, they can see how it compares to their performance in previous years, and then they can decide whether to invest in a particular company by buying their stocks. Or then there are others which are not listed companies and they also require finance, so they raise different rounds of finance, that this is round A, round B, round C. So these are the companies where they again require funding, and they are the people who are the investors. Sometimes an angel investor will put in a little money into startups, and then there are institutional investors, and then they do the due diligence and find out whether should they invest in the company. So usually these are high risk investment which goes into startups, and which goes into public limited companies. They are not that high risk, and even then there are portfolios where they are high risk and medium risk and no risk, and there are companies they pay you dividends, and but you are not really concerned about the stock going down. And perhaps like Coca-Cola, Pepsi, these are the companies where you can just invest, and you know that the stock remains where they are, but they make profits and they divide the profits into their investors. So again, it's for an individual, it is difficult to learn all these things, all the options which are available to him, and at the same time, even for the companies, it is difficult for them to, if they need investment for expanding their business. So again, they need to look for some institution that can help them. I know for sure, like, because I'm in Shifa International Hospital Board of Directors. So once they wanted to expand and they wanted to have another hospital in F10, so they have started constructing it. So they wanted other investors to come in, and they wanted a big investor to come in, and they have this institutional investor who they could find, and that has invested into, I think, about 15% of the equity has gone to that investor, but now they are expanding. And perhaps that is the only way companies can expand, by getting more finance. But so you need very intelligent people here, or the brokers that who can just deal with the investors and the companies, and these investors have your money. Okay, so you are investing in them. Once you deposit your money in the bank, and the banks are using it to invest it, and then they give you a return. And if you don't want to take any risks, so you get uh, just an interest on it. And but if you take risk, and then you can also lose your money. The role of media and analysis, and then I said about this Harvard professor who says problem is here that there is an asymmetric information coming from the CFOs. Even the owners don't have a clue that how the CFOs and CEOs are running their businesses, and they may play them a very rosy picture and play a very rosy picture because they know how to present the numbers. So it is important for the analysts to go deep down and find out the how actually a company is performing. And today we will learn some of these things. Asymmetric information is the main problem. And then this is what we were discussing once we ended our session yesterday, that no matter what business you,
What is the meaning of AKA in the last slide?
Ji.
Sir, in the last slide, uh, the meaning, the problem is asymmetric information, AKA the principal agent problem.
Yeah, principal agent problem is that here these are the people who are the principal agent, and you just got to believe in them. Okay, so whatever they are presenting, it says, because even if there is an owner, he has to rely. If it's a big business, okay, there may be a Seth running a textile mill, but then he must have to hire like these trained human resource, which are the CFOs.
Sir, that is understood, but I'm just asking about is it some specific word which comes out from AKA?
Oh, also called as AKA is
Oh,
also
right, sir. Thank you.
also known as also known as hota hai is like
Right.
also known as the principal agent problem, also known as the problem of modern capitalism. ठीक है. अच्छा. अब ये this is a very interesting slide that just teaches you the core of finance. This is no matter what business you are in. Okay, so large businesses and even small businesses, and you got to deal with this. Okay, and this is what the analyst would look. And then I'll show you a slide. Yesterday we were just started discussing the Apple slide. So this is about a sales cycle that you got to get some inventory into your business, bring some inventory into your business, and then there is some time. If you're doing a manufacturing, that manufacturing will take some time for a product to get out in the market, or even if you are just a trader, still you need to wait for a customer to come and buy that product. So there is going to be an average time where the product will be just there in the inventory on your shelf and waiting for somebody to come and buy. And then there are businesses where the people who get this a product will not immediately pay you. Okay, so most of the big businesses they run on credit, so they will take it. And if they're just sometimes there's a cascaded businesses that somebody takes from you, and then a retailer goes to a shop, and the factory to the retailer to the shop. So mostly, and then the people who get that from you would take some time to pay you. Okay, so large quantities, you put things in the inventory, and then so let's say in this particular example, they are like take you to complete a sales cycle in 90 days, but you have promised your vendor that you'll pay him back in 30 days. So in 30 days you have this margin and then you pay, but if your inventory is still there and you have not gotten the payments, you got to run your business for these many days. So you got to have a cash to run your operations for 60 days. So this is important that your business should able to support your operations for the days once you are not getting any cash from your business. Okay, so this is I showed you about Apple, that how Apple has controlled this, and obviously the analysts can have some better insight into different businesses, and then they can appreciate that Apple is running their business in better than maybe some other companies. So this is the inventory. So they only keep 3 days of inventory. Okay, so means that 3 days means that they are not just putting something in their inventory which is of value and keep it there. So they are making sure that their vendors, whenever they are asked, would take hardly any time to bring the inventory to their stores, and so they are not investing. The vendors are investing into the inventory. So just 3 days of this, and then is that the time once they sold out a stock of maybe iPhones, and they want used to have like 50 days. They give them to pay the amount, and now it has reduced to like very few days, maybe 5-10 days. And whereas they pay their suppliers here is more than 100 days. So So their vendors, they take 100 days. So whenever the vendor is bringing something, they say we will pay you in 100 days. So 100 days means that they have something which where the vendor has spent their money to build the stock, and they are selling it, and they're not even giving it to them, and they get the money from the sale in few days time. So there, this is important, the cash conversion cycle runs in negative, so it is negative so many days. So they are having this cash which is not their cash, so to say. Okay, this cash has to go to the vendors. They just keep it to expand their business, so they don't need a penny to run their operations. So this is just an amazing way the person whosoever is running the Apple's business has made this type of an improvement, as you can see in few years time, going from here to here. Is the strategies, and that's how perhaps the people who are in the administration, the executives, that's what they try to do. And the people who have successfully done this, or in maybe there may be other businesses where um, you don't have any cash to run your operations because all your cash somehow is invested in the business itself. Okay. So it is about capitalism. All the investment that people are making is capitalism, and talking about capital. And what is capitalism? Capitalism is that all the businesses, the production houses, the service houses are owned and operated by private people for making profit. So this is the most important aspect, that everybody who owns a business or a service wants to make more and more profit. Okay. So this is an economic system in which the means of production of goods or services are privately owned and operated for a profit. So all the businesses which are privately owned, they want to make profit. So people are just finding better and better ways of making profit. So capitalism hai, they believe in few people getting very rich, and then these people, through a trickling down effect, that once they are rich, they just keep spending their money. So the money trickles down into the economy and into the people. So capitalism works where you can have a great divide between rich and the poor. Rich making more and more and more money because they have more capital to play with, and the poor people can just wait for that money to get down, to trickle down into the economy, while they go and lavishly spend that money onto different things. So, so we are not preaching capitalism, but this is what most of the world is uh, uh, following the capitalism, because it gives more energy to innovation, more energy for country's economy to earn money. Maybe like the money is with few people, but at least it is coming. The businesses are running, and it is coming. And even in China, there is a lot of privatization, and there are many people. If you go to China, you find out that there's sometimes they look to me richer than Americans, because the type of cars you see on their roads, and the way they're getting richer every day. And definitely there are two classes, but it starts generating a middle class as well, because middle class start getting employment, so it expands the middle class. It makes more people richer, and that's what is happening in India as well. And if you see, the poorer may get more poor, uh, but then there is a middle class. So there is a thriving middle class because they get employments and they get opportunities and they get jobs. So because rich people want to make more money, they invest, they expand their businesses, and that's the ecosystem. So this is what the analysts would do. Okay, so analysts जो हैं, once they are looking at a business and finding out whether they should invest in that business. This is again coming from the Harvard professor uh, slide, or he also has a book on this, which talks about that how things have changed, and from 1960s to 2020, and what the analyst would look into a business, whether it is profitable or not, whether it is worth investing into a business or not. And he said people would usually worry about the revenue. Even in Pakistan, once people ask me, even they ask about revenue, what is your revenue? So perhaps revenue is kind of a meaningless thing. You may have a revenue running in billions of dollars, and still if you are in loss, then what is the purpose of that revenue? Okay, so revenue perhaps the very poor indicator of how good a business is performing. Revenue is that how much money you are getting for your sales, and without worrying about that how much actually you're spending to make that revenue. So revenue was one. Then people started thinking that instead of just analyzing the revenue a company is making, let's worry about the net income. And then they said is revenue minus expenses is the kind of net income, and then is the EBIT. EBIT is earning before interest and taxes, and they want to see how effectively their operating income is. They say let's not at this point worry about the interest and taxes, and excluding that. Before that, let's see how much money the company has made. And then is another indicator people started using. It is EBITDA. EBITDA is earning before interest, taxes, and devaluation, amortization. So we'll cover this as well in a while. And then is the operating cash, and then is the free cash. So people prefer to use a free cash. The investor would now like to look into that, what is the free cash available with an entity, to find out that how good it is performing and whether should they invest in that venture or not. So this is EBIT. EBIT, as I said, is earning before interest and taxes. So they gauge the performance of company's core operations without the cost of capital structure and taxes. This is the operating income, and this is the net earning before interest, taxes, depreciation, and amortization. And you know what is depreciation? Depreciation is if you have bought, let's say it's in hospital, it has bought a 4 crore rupees worth of medical equipment. So every year it'll start losing its value. So they understand that if its life is, let's say, 10 years, and they know that they have to replace this 4 crore rupees worth of equipment after 10 years. So they every year they start depreciating its asset value, so that they precisely know that what the current assets are. So they must not say even ninth year of its operation that it is still 10th crore worth. And once you are looking at a business, they must only show that this asset is worth 1 crore rupees, not 10 crore rupees. So these people, like the CFOs and the people who are doing finance, they got to very carefully do the depreciation of every asset every year. And they reflected in the financial statement, because once you look at that, you know that what are the assets worth at this particular point in time. And amortization is if it is a loan the company has taken, and usually it is again spread over 10 years or 5 years. So a loan has to be reflected that you have to return that loan, and it is usually spread in, let's say if it's 10 years loan, so 10 years you have to pay every year. So you got to in your assets, you got to have these two things that you got to take out while you want to see that how much free cash you have, because end of 10 years you have to buy that equipment again. So it's better that you just take care of these things. So net earnings, people have this EBITDA where they, without doing the depreciation and the amortization, they have some number which tells they how good a company is running its operations. So it's a short-term operational efficiency, because in the long term, the depreciation and amortization has its role to play. Operating cash is cash generated from customer minus cash paid to the supplier. And then this is the most important, which is the free cash flow. Shows the cash that a company can produce after deducting the costs. I mean, here you put the capital investment you intend to make as well. If you want to buy, let's say, an equipment, or if you want to build or construct a building, so you also take out that you are going to do this. So that now left is the free cash, and the investor would love to see that how much free cash is available with the company for it to do different things. So major the investor would like to see this. So as it last point says, FCF measures a company's ability to produce what investors care the most, the cash that is available to be distributed in a discretionary way. They can have their dividends if they are already investors who have invested. So sometimes there is scope for called something which is called retained earning. Retained earning is that you sorry, I got disconnected. Let me get these slides back. Get the camera back. Okay, so you can actually go get the financial statement of any company before you invest in it. So they are bound by law that they have to provide this to everybody. If it's a public listed company, every quarter they basically with the statement goes their financials or income statement, and you can easily now knowing all these you can easily understand uh, an income statement that would show revenue. So revenue, as I mentioned earlier, is something which is kind of meaningless, though it does tell you the volume of business they have. And it says, okay, this is the volume they have. And then it is called cost of goods sold, that the amount of money you have spent to make that sale, which has created this revenue, you directly need to take this out. Once you take this out, this gives you profit. Okay, and then if you have some expenses relating to advertisement and marketing and promotion, you take those out, and then you are spending something on general administration which you have not taken out here, so you got to take those out as well. So all the expenses that has occurred to get this revenue has to be taken out. This is your EBITDA. And at this point you still have not taken out the interest and the taxes and depreciation and amortization. And then what you do is you take out the depreciation and amortization, which you have spread over the years, as you can see here, in dollars, so 6,000, around $6,000 every year. So you take this out as well. So this is your EBIT, and EBIT is still you need to take out the interest that if you got to pay some interest every month, that has to be taken out. So this is the interest that of the money that you have taken, which you have to pay to somebody. That is, if it is there, you have to take that out, and then you take out the taxes. And if you take out the taxes, now this is your net earning. So this is kind of the earning which you are going to have after out of the revenue. And look at this general profit. So many a times I have seen that though your revenues are increasing, but you are making lesser and less money, your net saving is decreasing because cost of business is increasing in Pakistan. And same has been happening with Shifa as well. So their revenues are increasing. So there are more patients. The hospital is kind of having more revenue, But once they compute the net earning, it is declining because the cost of business is increasing. The medical equipment is getting expensive every day. The surgeons are getting expensive, and so the doctors are getting expensive. So, but they cannot just increase the fee and the charges for the other services, because looking at the paying capacity of the people, they have to decide. And perhaps same is the case with private universities, other private businesses, that they have to work on their margins, and they got to make sure that still they can have maximum people who could benefit from and be there, remain their customers. So this is yet another income statement, and you see almost the same thing: sales, cost of goods on selling and general administration charges. Then you have EBITDA, and then you have depreciation, amortization. Then you have EBIT, and then you have interest and taxes. So that would be a free cash available to you. So analysts are important, but you knowing this little bit, if you intend to invest in any stock, you can just go and look at their income statement, and especially look at the net income and how it performs. Usually they perform always. So I made people to do the following. There is something which is called a vertical analysis. A vertical analysis is that so a vertical analysis in a financial statement, but not to the public, but to the board. We ask them to give us a vertical analysis. And let me explain you what is a vertical analysis. Vertical analysis is that, okay, if this is 82,000, which is your revenue, so how much expense do you have in producing this revenue? You say 40%. Okay. So if this is 100%, almost 40% has gone into the cost of goods sold. And how much is the operating? I say, let's say about 15, 16, 17%. Just I'm putting rough guesses. And how much is the administration charge? About 10%. And how much is the depreciation? You say almost 8%. And how much is the interest that you are saying? You're saying almost 10%. And how much taxes do you have to pay? And it's almost 10%. Okay, sorry about, I don't know why it does this. So you, by looking at the vertical analysis, you know that where you are spending the most. You say, oh, we are spending too much money in marketing as compared to the revenue you are making, or in general administration. Then there is a horizontal analysis. This is a horizontal analysis. Horizontal analysis is that if it is 100%, so let's say what is the maximum is, so these are the 18, yeah, if this is the current year. So you say that how much in percentage your revenue has increased from last year, and you say there is 3% increase. But also then you say cost of goods sold is 2% increase. And then you say administration is almost 0% increase, and general administration you say almost 0%. There's no change. Depreciation you say 0%, and interest you say 0%, and but you say income tax has increased, and you say 2%. Sorry, 2%. So you do a horizontal analysis where you take every row, and from the last year you just tell that is there anything that has increased, and you say yes, revenue has increased. But then you say revenue has not increased, but the cost of goods has, that running that business, the cost is increased, and you say, or you have put more money in the advertisement. And so you do uh, a horizontal analysis and a vertical analysis. That gives you a better picture that how your business is running. And you can just, looking at the numbers, you can just tell. And if you plot them graphically, it is even better, that it just tells you that, for example, for last couple of years, you say this is my revenues are increasing, and but my cost of goods sales is increasing even at a sharper rate. So that tells you that this slope and this slope is very different. So you are spending more and more. So this is your revenue curve. And then you can do the prediction as well. Cost of goods sold. And you can do the prediction as well that this is, if you keep running the business, let's say in 2022. So this
Sorry,
is
sir.
how. जी बताइए.
Are you displaying uh, um, on a drawing board because we only see the slide?
आपको ड्राइंग बोर्ड नहीं नजर आ रहा?
नहीं.
एक मिनट.
किसी ग्राफ की बात कर.
जी मैं एक मिनट इसको सीधा करता हूँ. सॉरी. अब नजर आ रहा है?
Yes, sir. Thank you.
अच्छा जी. So let me draw this again. So what I was telling you this is that there is a horizontal analysis and vertical analysis. Okay. Horizontal analysis, usually you want to see graphically as well. Let's say your revenues and you say, yes, revenues are increasing. So this is a good indication that from starting from year 2000, and this is your year 2021, and you see the revenues are continuously increasing, and you can do prediction as well because of more population, or more demand, but you see a very constant trend. And usually there's in big businesses, there's usually a trend. And you say, I know that in 2022, my revenues, and that's how they put the targets in their budget. Once they present it to the board of directors, they say for the next year, there will be this much increase in their revenue. But then you also look at the cost of goods sold. Okay, this is the cost that you are making this revenue, and it is here. And if I plot it on the same, you say this is, or it is going. Let me change the color. हाँ जी. Let's say जो cost of goods हैं वो कुछ ऐसे जा रही हैं. Okay, and you know that the way that the money you are spending to just generate this type of revenue will be more than the money you are making. So you got to then suggest that this is what you suggest, that to increase your revenue, what are the ways of increasing revenue without getting more, spending more money on earning that revenue. So you have a trend in vertical analysis. This is your revenue, and this is cost of goods sold. So the vertical horizontal analysis is very important, and looking at the curves and doing the predictions and the analysis that how this business is going to perform in future. The other one is a vertical analysis. This tells you if this is your total revenue, and you find out this is the money that you are spending on the cost of goods sale, and these are the taxes that you have to pay. This is the interest you have to pay. These the D&A, and this is on the advertisement, operations, and maybe on the this is your free cash. And you say out of this revenue you have only, let's say, 20% free cash, and these are your profits that you are actually making, not the total revenue. And you say you have like, and this is if you want to retain part of it, this is called retained earning. Retained earning is earning that you want to do back into the business, and then you say only, let's say, 15% is available as a free cash, and this is what you say that you will give it as dividend, as a profit to your investors, dividends. And so investors want more and more of this, but obviously this is up to the CFO, CEOs to present to the board that this is what we suggest, that we don't think that we can give more than 15% or 10% of the revenue to our investors as a dividend. And looking at this, the stock also goes up and down, because looking at this, the analysts, and they would just write that though it is increase in revenue, but company is making lesser profit, net profit is going down, and that affects every quarterly. You must have known that every quarter they need to just announce that these are their targets, and if they meet their targets, so at the announcement of the targets, so there is some movement in the stocks, and once if they meet or they don't meet, there is some movement in the stock. Either they go down and go up, because either people invest more or they take out their money and spend it somewhere else. Okay, but there's no smart contract which is doing this. This is important. Like, you can have a smart contract which is doing all this analysis by themselves, reading the income statements of different companies, finding out how different companies are performing, which company is performing better than the others, and then analyzing the entire portfolio, and then automatically suggesting that this is where you need to invest. So once we learn about DeFi, so DeFi is here. It's a decentralized finance. So it is here, and it is dealing with cryptocurrencies. But interesting is that in there are no direct investment in cryptocurrencies. Like, you cannot just take a cryptocurrency and invest it in Coca-Cola or Pepsi or Apple or IBM or even in NetSol, or Barize, or any listed company in Pakistan. So this is where the real businesses are. Right? But then there are here people who can invest. Here, if you want to invest in a business, so you usually need to go through a bank. So you can invest directly as well, or you can invest through mutual funds, or you can invest through hedge funds if you are rich. And so there are different ways that you can invest into these businesses and get return. But interestingly, there is a way that you have a cryptocurrency, though you lend here and somebody invest here and get the returns here and pay you back here. Okay, so this is the beauty of DeFi. That you are now trusting a smart code, a piece of code that has all this intelligence, and you say, okay, I am lending you this, the platform. So this is a software which is being managed by many people, and this is just piece of software, and you say, okay, this is my money. And you can have money actually in dollars, and this is another fun part, that you can invest in DeFi by investing in dollars or investing in cryptocurrency. So, and the people who are borrowing, they can actually just get your money, invest, or they can have um, uh, the cryptocurrency, and they invest in cryptocurrency by just and then whenever you are putting your money in, so you want to make sure that this platform will not eat up your money and say, sorry, you have not gotten any returns. So you got to make sure that if you're investing $100, at least you get your $100 back. Okay, and that's the comfort that the DeFi platform gives you, because anybody who comes to borrow this money, he has to put some as a security, and we will learn about that in a while. So this is a bigger paradigm, but I hope that you understand that how even if there is a smart code, and this could be, as a matter of fact, a very interesting thesis as well. And anybody who wants to publish a smart contract which is looking into the financial statements, income statements of different companies on the portfolio, doing the horizontal and vertical analysis, finding out their stock value, and seeing that the company is doing better or performing poorly, and then making a decision that how to, through a smart contract, how to invest in a business. So this seems like a very, very interesting topic. Anybody who wants to work on this, that you are now changing all of this into a smart contract. Okay? A smart contract is just doing all of this for you. And from a DeFi platform, you come and you invest in the company, and the returns you take it back to the DeFi platform. So, अच्छा अब आते हैं कि how do you invest in a business? So one is, if it is your uncle's business or your cousin's business, he can just come to you and say, "Okay, yaar, yeah, this is what I intend to do. Why don't you put in your money?" And you may or may not even put it in writing. Okay. Ultimately, this is what you want. A business wants your money to be spent on its expansion or even to start a business. But then, because you got to scale it up and you got to make sure that people who don't know where they are investing and they want to invest, there has to be a framework, an ecosystem where the people can just invest. Ultimately, everything goes to an actual real business. Okay, whether a bank is giving you interest, ultimately it has to be spent on a real business for it to make money. Okay? It has to be spent on a real business to make money, or it has to lend to a person who could just use that money to meet his immediate need, and is willing to pay back more because he does not have uh, that money at that time where his need is. So these are called financial instruments. And financial instruments is a mechanism where here is a business. I think I like red color more because it is a bit distinguished. Let me, okay. So here is a business. And here is you or general public who is an investor. Okay. So you got to build an instrument through which the investment can get into this business. So these are called the instruments. So instruments that basically can take your investment seamlessly and feed it into a business, and if business performs better, that your investments gets repaid and you get returns. And there may be another layer where the people who understand it better are basically providing you with this service. So there are actual people who are just using their services. Says EFU guy comes in and he says, we have a very good program, we have this mutual fund and you can invest and we guarantee you returns in 5% to 15%, and this is our previous history, and they tell you all kind of stories they need to decide. So these are called the financial instruments. And as I mentioned earlier, even if you are investing in DeFi, decentralized finance, ultimately you got to invest it here because the real businesses are here. So you got to buy the stocks and shares and bonds and pay for the mortgages to people, and then there are derivatives. So looking at these instruments is very interesting plot which I found on the internet. It says the different instruments have different contributions into the financial system. So this is about quadrillion. Quadrillion is about 250 trillion dollars are derivatives. So these are called derivatives, and we'll see what the derivatives are. 130 trillion are the bonds, and we'll see what bonds are. 70 trillion are the stocks, and we again see what is meant by stock. And then crypto is increasing every day. It's about $2 trillion, and it is increasing. Still, it is smaller, but the crypto, as I mentioned earlier, is also kind of an instrument that feeds back into the businesses. So though you have this cryptocurrency, all these DeFi platforms is making sure that you have this crypto, and crypto you can lend to the DeFi framework, and then somebody can actually take dollars out of it, invest here, get the returns, and goes back and pays the return back to the DeFi platform. So crypto is also one of the instruments. So these are bonds, stocks and bonds, and these are also called securities. So these are sold to raise money for starting a new company. So or expanding an existing business. So this is the framework I was talking to you about, that you have now your business, and here people who intend to invest, and this is how you can get their investment by offering them shares or stocks. Maybe you can get the ownership of my company, you can get ownership in my company if you buy some of my stocks and shares, and they get part of the equity. So means ke ab wo aapke they are part owner in the company, right? And the other one is that you don't want to make them be owner, and you say I am willing to pay you. Once they become an owner, they are in share in the, they have their own share in profit and loss. If company makes profit, so they get, you know, rewarded. If company is in loss, then they have to they lose their money as well. So here is the risk. Okay, here is the risk that anybody who's investing in stocks he's taking the risk with the company. Anybody who is investing in bonds, which many companies issue, he is not taking that risk, but he's only getting a percentage of the money, the principal he has put into the business, and then he can redeem after, let's say, 5 years or 10 years. 10 years, if it is $1,000 and a company says, I have this $100,000 bond, I am willing to pay 10% interest on this every year, and after 10 years I'll return $1,000. So this is something where every month you are earning something, and then at the end you get your principal back. Okay, so these are the bonds. So and once we called about security, and that is what we have, Security and Exchange Commission of Pakistan, SECP, because then every country has a Security and Exchange Commission. So it has to be governed because the businesses are getting money. It is public money. They want to make sure that nobody rob public from their valuable assets and money. So they basically regulate and they make sure that there is no foul play, and there are very strict rules and regulations of public limited company, because public is putting in their money. So they are very strict about that, and they want kind of 100% visibility of public into the business, and that is the compromise you make. Once you go public, you got to open up your businesses, and you have to precisely tell कि भाई किधर किधर क्या क्या खर्चा हो रहा है, and how much money you are making. And then because they all are owner and they come in a general body meeting and they can shout at you कि भाई I put in my money and you are not giving me any dividend, and the business is going down, and this is happening, that is happening. So you take risk of letting others to be owner in your business, and sometimes people don't want this, and that's why in Pakistan majority of the businesses are owned by families, and they don't want to take them public. See, because as you take them public, then it's very different story. Then आप वो काम नहीं कर सकते बहुत सारी. Then you have to be very fair, and you got to make sure you are running the business according to rules and regulations. You are not violating any, because you have to report to the board, and then the board has to report to the general body if there is any foul play. So taking a business to public is good, because then you can have public money to expand it, but then it is no more your business. It is you are also a shareholder, and if company is making money, you are making money. If company is losing money, you are losing money. So उसमें ये आपके compromises होते हैं. So Security and Exchange Commission of Pakistan जो है वो इंश्योर करता है, और exchanges means के you have like stocks are trading hands, and you buy them and you can sell them. So are the bonds as well. So you buy them and you can sell them. You say, okay, 2 years after just reaping the benefit, and you say, I no more, I just want my principal back. So and they are brokers, and they are companies who deals with bonds and stocks which companies are issuing, and the people who buy them are the investors. Okay, I hope this is pretty simple. And stocks are, as I mentioned, it is the ownership in the company. Okay, so you become an owner in the company, and you are eligible for dividends, and you can vote in their shareholder meetings. And so stocks are like this कि आप उसका एक ओनर बन जाते हैं. और जब कंपनी IPO जाती हैं, initial public offering, this is called, if you start a business and you want to take it public, so then you fix some date, where you offer your stock for public, and you have an initial public offering. You set up a price, and if people start buying it, so you just keep shedding the ownership from yourself to the people who are buying the stock. So once company goes public, so there are IPOs, and people are very keen to buy the stock once something goes public. So they know that once they are part owner in the company, they can get dividends and can earn money on their investment. But if it goes down, then they lose their money as well. So you got to be cautious. Bonds are less scary because you are not buying and nobody's selling you the ownership in the company. So company decides that how much stocks they have to offer and how much bonds they have to offer. So that bond is a liability, because every year, first you have to return the principal. Once somebody has your shares, you don't have to return the principal. You just have his money and you spend it to expand your business. And he can only be a partner in earning profit, but then he has a say in your business. A bond, if somebody has bought, he has absolutely no say in your business, and he is primarily would just get some money, and sometimes government issues bonds in Pakistan and even in USA. So the government, if they need money to spend on a project, they are building a dam or a motorway, or so they want public to invest in those projects. So they will issue bonds for 5 years bond and 10 years bond. In Pakistan, there used to be also a price bond. Still today must be price bond, where instead of giving interest every 6 months or a year, they announce prizes. So there's a draw, and people, almost many of them, like 10-20% people, they earn some kind of a reward, and so they are happy and they know that they can just go back and get it cash for the same value. So once they claim, they can actually reclaim the money, and so this is what the bonds are about. So you can just read through this. I put it for you to just read. But this is how primarily this works. This is called the coupon payment. Once the pictorial diagram, I would explain from here that this is where a company or the government has issued some bond, and you, as an investor, once you buy a bond, you are investing into that venture. Okay, if it is a company's bond, so you are investing in the company, or if it is the government, then you are investing in some government project, and then government start paying you a percentage, and usually this is a small percentage, not a big percentage. So this is called coupon payment. So you get paid, and then a company repays the principal. So you get back, if it is a 5 years maturity or 10 years maturity, depending upon the project, and then they redeem. So you redeem your bond and get your money back. And if it is trading hands, so the last person who has it after its redemption date, he can go and reclaim his money. Okay, so it's even has the owner's name and the value and the serial number and the issuing date, and so all of this is there on this bond. Okay. So this is these stocks are traded on an exchange. For example, Nasdaq है, कराची की हमारी exchange है, इस्लामाबाद की exchange है. So you can exchange and usually now there are softwares, and you can use them to trade your stock and offer your stock to people, or you can get the help of a broker, and he would just do this for you. You only have to tell him that this is you should set it. Usually if you have, like, it's 100 rupees value, and you say if it goes 105 I want it to be sold, or if it goes 90 I want it to be sold, otherwise I'll not sell it. So you can tell your broker, and he'll set these limits, and so automatically once it hits 105 your stock will be sold out, and the money will go in your bank account. But the bonds are called the over the counter, so they are not traded in stock market, and they are over the counter. So they're brokers, and they would actually be selling your bonds to professional investors. So through the brokers, like so for example, these are some of the brokers: Vanguard, Fidelity. So a company can have brokerage accounts as well to find out which company has offered bonds. The most interesting is the derivatives. Okay, and we will see that these derivatives are there in crypto finance as well. I think कि हम थोड़ा सा break कर लें. Let's just take a 10 minutes break, please.
जी सर, नमाज की भी ब्रेक हो
हाँ,
जाएगी.
नमाज की ब्रेक कर लेते हैं, 15 मिनट्स की ब्रेक कर लेते हैं.
ठीक है सर, थैंक यू.